are in charge of strategy there in terms of investing at Citi. How are you strategizing right now in this market?
Yeah, the calendar's a big part of that. We're right going into year end here. It's been a really difficult year. So I think a lot of people are trying to be long the market, but also kind of manage their risk. Two or three things that I think have changed recently that are really on people's mind. Number one was consumer earnings in 3Q were a little bit challenging, and management kind of guided to a weaker consumer. So we're keeping a close eye on that as it relates to holiday spending. And then you've got the Fed, next week, which is, front and center, huge event for the markets.
And now I feel like everyone's expecting a cut. I mean, first we were like on the fence. The Dow Industrials were up 400 points yesterday. Market was higher across the board as this melt-up continues now with new emphasis on the Fed next week. The Dow this morning up 69, the S&P and the NASDAQ higher as well, because there's this new optimism that the Federal Reserve will cut interest rates next week. Is that what you're expecting? Is it another quarter-point cut that you're expecting?
Yeah, we are expecting a quarter-point cut. To our economists' credit, they've been of the view that they're going to get a cut, even as the odds kind of round-tripped a big move. Markets are basically fully pricing a cut right now.
Now we're up to 90%, that 90% chance that the Fed cuts.
Exactly. So if we don't get that, it's going to be a big issue. I think what the markets are now thinking about is what is the Fed going to do in early 2026, particularly if we have a new Fed chair. So the Fed is important next week, and then the week after that, you get all the employment data and the inflation data that we missed. So the Fed's important, and then we kind of get into that key economic data that's going to really pave the path for 2026.
Yeah, it's a great point. I mean, the market responded to November's ADP number yesterday, showing that we actually lost jobs in the most recent report. 32,000 private payroll jobs were lost. September's delayed PCE index will be out tomorrow morning. But, Stuart, I'm worried about jobs. I think this is the one weak spot, and it's not about the macro story slowing down. It's more about AI and efficiencies that will replace white-collar jobs. I mean, thankfully, President Trump has been pushing trade schools because we need, 1 million new engineers. We need 1 million new electricians, plumbers, etc. So the trade schools part of this story is important. But what happens to those white-collar jobs that I think may go away, some of them, because of AI?
Yeah, and I think you're seeing that a little bit in the jobless claims data, which is you're not getting a lot of people laid off, but the continuing claims are very high. So if you do lose a job right now, it's actually hard to find a new job. And I think AI plays a role in that because if you lay off someone, I think your manager is saying to you, prove to me you can't do this job with AI for the next 6 to 12 months. And if you can't, then we'll let you replace. So I think the early sort of shot across the bow on AI is the difficulty in finding a job once you've lost it right now.
Yeah, it's a great point. And I asked President Trump, what is the plan for AI and jobs, given the fact that no doubt we're going to see AI efficiencies and that will remain, that will mean job cuts. So we'll see what the administration comes out on for that. But I want to get your take on autos, because the president was with a lot of auto executives yesterday. Auto stocks this morning are up. The president announced an historic reset of the Biden-era fuel standards. The White House says this plan is going to save American families $109 billion in the next 5 years, John. They're lifting regulatory burdens on the automakers. The president, flanked by top executives from Ford, GM, Stellantis during that Oval Office announcement. How did you see that?
Well, this has been a great year for auto-related stocks. I think Ford and GM for the year to date up by 30 to 40%. A great year. Nevertheless, when you look at unit sales of cars and light trucks, they're down considerably from where they were prior to COVID. They're still off by nearly 9%. And we're also looking at quite a drop by unit sales of cars and light trucks from the third to fourth quarter. And that's part of the slowdown by consumer spending expected for the final quarter. You want to get more auto sales? It's going to help if you have Fed rate cuts. That's going to go ahead and lower auto loan rates. That would be a positive. But a lot of consumers still have a problem. They struggle with a higher price of new motor vehicles.
Yeah, I mean, look, we got to talk about the AI trade, Stuart. I mean, Microsoft yesterday was down. We've got more speculation and commentary about what it's going to mean that all of this money has to move into AI. I mean, the company is denying reports that Microsoft actually lowered its sales quotas for AI software after many of its salespeople missed their goals in the last fiscal year. The stock was down better than 2% yesterday. Here's a look at the week and what happened yesterday for Microsoft. And I asked Jensen Huang, Jensen, when are we going to see a return on equity for these trillions of dollars that's gone into AI? I asked him just a few weeks ago. Watch this. Jensen, I want to get your take on all the money moving into the AI infrastructure build-out. How much are you expecting that to be, and will we see a return on investment in that money soon?
Artificial intelligence in the last year made some humongous breakthroughs. It is now effective, it's useful, it's generating really good results for users. It's impacting every single industry that we're observing. Everything from healthcare to, of course, enterprise computing, where we do work, and whether it's manufacturing, robotics, we're seeing breakthroughs in every industry. That platform shift is just beginning, and we're just seeing it so strong and accelerating because now fundamentally, finally, AI is delivering really great results. And it's the reason why we're seeing the fastest growing companies in the world.
Maybe, but Microsoft is one of those companies, and the report yesterday said that it's lowered expectations for how quickly it can get customers to spend money on new AI products. So, again, questions about ROI with all this money going into AI.
100%. And I think you saw that during 3Q earnings. The reaction function to AI earnings changed a bit. And you could look at Meta, you could look at NVIDIA, you look at Palantir, you could look at Oracle, you could look at Microsoft now, where the headlines that previously were pushing these stocks higher are now forcing people to ask questions. I mean, our strategists estimate $5 trillion in CapEx spend over the next 5 years. And you're asking the right question is, who is actually going to get the benefit of that? It doesn't seem like the people that are spending the money might get the benefit. It might be the recipients of that spend.
Yeah.
So AI power generation, which I know you and I have chatted about in the past, is an area. Maybe you want to be in the stocks that are getting that spending as opposed to the stocks that are doing that spending right now as people start to question the ROI.
All right, well, that's a good strategy. Look, let's look ahead to next week, because it's not just the Fed meeting that's important next week. You've got Oracle earnings. And Oracle, of course, is also in that software space. What are you expecting from Oracle? How would you approach that stock going into earnings?
I would approach it cautiously, mostly because if you look back to the last earnings they reported, the stock was up 35 or 40%. They've round-tripped that. And during that subsequent period, their credit spreads are now at the highest level since 2009. So I'm not saying that it's going to be bad news, but this is a stock where there's a tremendous amount of focus from Wall Street on their spending plans, the timing of that spending, and how they're going to finance it. So this is going to be a huge, huge event for markets. It could be good, it could be bad. We'll have to see what they say. But based on what happened in September, I think people are going to be really focused on this number.
I'm glad that you flagged Oracle. Thank you for that. I want to get your take on Alexandria Real Estate Equities. They cut their dividend, the quarterly cash dividend, by 45%. Now to 72 cents a share. The stock hit a 52-week low yesterday. The board says the decision reflects, quote, the commitment to fortify its already strong balance sheet, enhancing financial flexibility, preserving liquidity of approximately $410 million on an annual basis. Investors are wondering if other companies are going to also, cut dividends in this sector. Is this an Alexandria Real Estate specific story? What do you think?
Well, let's face it, the stock of this company fell by, what was it, 10% yesterday? It's saying if companies go ahead and start cutting dividends, you can only expect lower stock prices. There's no avoiding that. This particular company, I guess, is having problems with the rising vacancy rate. They do life science facilities. It's a real estate investment trust. They're also having problems with still relatively high interest rates. They need lower interest rates in order to refinance these developments. They currently have problems with a property in Long Island City. They've had impairments. What it comes down to is that life science companies are simply not spending as much on R&D as had been anticipated.
That's the bottom line. We've spoken with the CEO of Alexandria many times. He's a friend of this program. And during the boom times, he was telling us about so many pharma companies, tech companies. This is where the business was in terms of rentals and leases. You're saying they're not going to be spending what they were spending.
They're not, and there's also regulatory pressures. May I mention one thing about healthcare? Healthcare is a funny industry. Great revenue growth, up 10% annually in the third quarter, but profits up by only 5%. That's unusual compared to other industries where profits are outrunning revenues.
All right.
Costs are too high.
Yeah, costs are too high. Thoughts?
Yeah, no, I mean, healthcare has been a tricky one, right? I think regulatory overhang has been a big weight on that sector because you've taken the valuation premium out of the smaller stocks because they can't get bought, and usually large cap healthcare buys growth. So both sides of the barbell have kind of been under pressure. We have seen a lot of upside, though, and people being interested in biotech over the last couple of weeks. So that may be a trade for 2026.
All right, we will leave it there. Stuart, great to see you. Thank you so much for being here. John, you're with us all morning long, and we appreciate that. Stay with us. We'll be right back.